Gold has a long history as a symbol of wealth and a stable investment. Despite the emergence of new investment tools such as cryptocurrency, investors continue to turn to gold for its effectiveness as a hedge against inflation and currency devaluation. It also acts as a stabilizing market force due to its unique supply and demand dynamics. Today, we will look at what is happening in the gold market and why is it rising with stocks and cryptocurrency. So let's look at what is happening with gold in the modern times. The gold standards limitations ultimately became evident when we see it during economic downturns, when countries needed more liquidity but could not increase the money supply without gold's backing. This ultimately led to its abandonment in the 1930s, which was culminated through the Bretton Woods Agreement post World War II, which pegged the US dollar to the gold. This system ended in 1971 when the US seized gold exchange for its currency. Since World War II, gold's percentage of global international reserves has declined, as you can see in the graph. However, recent geopolitical events and economic instability have renewed interest in gold. The freezing of nearly $300 billion in Russia's assets due to Ukraine war and the US's increasing debt and inflation issues have led to central banks around the world buying record amounts of gold, which is ultimately driving its price up. So the first thing is gold can be used as a hedge against inflation. Gold has long been regarded as a reliable hedge for economic downturns, such as in the 1970s when there was very high inflation. Gold prices skyrocketed from about $35 per ounce to nearly $800 over 1980s. This is a significant increase over one of the most turbulent economic times and shows how strong and resilient gold has been as a protective asset. Now, when we look at 2008 financial crisis, gold again proved its worth. Stock prices plummeted. Investors flocked to gold where the price was higher and it was ultimately safeguarding their overall net worth. Similarly, during geopolitical uncertainties such as Israel-Iran conflict, the recent Ukraine-Russia war, and many other geopolitical events in history, we've seen that gold's status as a safe haven and its investment option becomes very evident. It offers stability, it offers reliability when the markets are very volatile. And ultimately, if you look at even COVID-19, we can see how reliable and effective gold was as a tool. In 2020 alone, gold gave a return of approximately 25%, outperforming the Nifty 50, which recovered around about 15%. Despite significant market lows. This performance ultimately shows how valuable gold can be as a hedge against economic instability and inflation. Now, there's a very obvious question that's coming up in the recent times is that there is also cryptocurrency, an alternative form of currency that is replacing not just gold, but also our traditional currency or fiat currency, such as US dollar, Indian rupees, etc. Let's do a comparison between cryptocurrencies and gold. Cryptocurrencies, particularly Bitcoin, were initially seen as a modern day replacement for gold due to their limited supply. Bitcoin is capped at 21 million coins, while gold can continue to be mined, albeit higher yield and higher cost due to decreasing yields, etc. This finite nature is what makes cryptocurrencies appear to be a strong hedge against inflation, similar to gold in that essence. The decentralized nature and the digital nature of cryptocurrency is also added to their appeal. However, the reality has been very different. Despite the theoretical advantages that cryptocurrency offers, it also has extreme volatility, very uncertain regulatory frameworks, and ultimately there's a security concern that we've seen with the downfall of FTX, Binance, and various other sort of crypto exchanges in the market. And ultimately, when we look at it as an inflation hedge, those inflation hedges have not really materialized, which has led to a very cautious approach in terms of their adoption. Gold's biggest advantage is diversification, as it moves independently from other assets. It requires disciplined rebalancing because it can lag behind the stock market at times. But when we looked at the comparison with Bitcoin, it becomes very interesting, where we've seen that there's been significant inflows to Bitcoin ETFs in the recent 6 months, despite the new highs that gold prices have also seen, where the AUM for, let's say, the largest gold ETF in the market is around 1/3 below its peak price. When we look at gold, it's also far less volatile than Bitcoin. So there is still room in the market for both to prosper, and there's enough growth that can still be seen in the gold market. It is also interesting to see if Bitcoin's demand will ultimately have an impact on gold in the longer term, since if Bitcoin becomes a natural movement for hedging against inflation, hedging or providing diversification for your portfolio, then what does gold serve as a purpose? While technology can rapidly change the landscape, betting against gold's long-standing history might be very premature. Now let's look at the returns that the stock market and gold have given over the last few decades. Let's look at, let's say, between 1928 to 1970, the gold's annual return was around 1.4%, below the 2% annual inflation rate. So it hasn't done really well. But when we look at it, let's say over 1970 till the current period, gold's return improves to about 7.9 or roughly 8%, while it's still lagging behind the S&P 500, which is giving roughly around 11% on an annualized return. The correlation is very important here. So the negative correlation of around 0.2 is what helps gold not move in line with the market, and ultimately provides it as a hedge against inflation and also a hedge or a diversification element to your portfolio. In the 1970s, gold prices had surged to nearly 1,300% with a 9-year annual return of nearly 33%, seen by some as a hedge against inflation, others as a correction from prior price suppression. From 1980 to 2003, gold's annual return was around 3.2%, which is falling behind stocks, bonds, and even cash, where the annual inflation rate was also roughly around 3.2%. So ultimately, gold's real return was essentially zero and hence had no real hedge against inflation. And this you can see in the graph that we had shown earlier. Despite all of this, gold does provide valuable diversification in specific moments of time. So for instance, if we looked at the period between 2000 to 2009, which is also referred as the lost decade, we see that while the S&P 500 fell by about 1%, gold rose by over 14% annually. When we look at, let's say, 2000 till 2023, gold's annual return was around 8.5% compared to the S&P 500, which gave only about 7%. And post the financial crisis of 2008, what we saw was that from 2009 to about 2023, gold's annual return was around 6%, while S&P 500 returned 13.8%. Now, naturally, there is this inverse relationship that we can kind of see here with stock market prices, and that is also very well documented. When stocks decline, gold prices tend to rise as investors seek a more safer asset. They want a safe haven. And conversely, when the economy is growing, when markets are doing well, investors prefer higher returns and ultimately move their assets from safer assets such as gold, cash, FDs, and move it towards stock markets. And this ultimately shows that there is a hedge that gold can give you during the sort of stock market fluctuations. Now, when we look at the current period, what we see is that gold and stock prices are rising together. In March, gold futures on COMEX were around a record high of nearly 2,200 an ounce, marking the 6th consecutive record finish. And you can see this in the graphs that we've shown here. Similarly, we've also seen Bitcoin doing really well with surpassing nearly $70,000. And both the S&P 500, the Nasdaq Composite, even emerging market indices are setting record highs in the last few months. The obvious question here is, why is this happening? The reason for this is a little complicated. There are a bunch of different factors that are involved in this. The first is that there is an expectation of the Federal Reserve cutting interest rates, which is boosting valuations across gold, stocks, real estate, and various other financial assets. And additionally, there's also a weakening of the US dollar that's happening in the market, along with geopolitical tension coming in from the Middle East, from Russia, Ukraine, and other sort of places as well, which are ultimately resulting in certain investors moving towards gold as a safer asset, as a safer haven. And that's also driving the price higher. Bitcoin's price rise is also sort of influenced by the same factors, which is anticipated Fed rate cuts, a weakening dollar, geopolitical tensions. With the approval of the Bitcoin ETF, that has also led to an increase in accessibility of this very complex sort of financial asset to a larger, wider audience of investors, which has also helped boost its value. Another reason for Bitcoin's increase is also that there is a greater media attention that is being given in the current context, where more investors are becoming aware about cryptocurrencies over the last few years, and that is also driving attention away from gold, for instance. Despite this, we are seeing gold and Bitcoin have benefited from low interest rates and economic uncertainties, with gold driving supply constraints and strong demand, and Bitcoin with its fixed supply cap and ultimately growing even institutional interest in the asset class. So is gold at a multi-year bull cycle? Well, recent developments may suggest that, given that we can see that technically it has broken out of a long-term consolidation phase, which was signaling potential for sustained growth, as we can see in this chart. In addition to that, we're also seeing that gold has been undervalued historically during periods of low trust in credit, such as World War II, late 1970s, 2008 financial crisis. Gold's value related to financial assets has ranged between 7% to 10%. Currently, it's sitting around about 3%, indicating that there is still room for growth. Additionally, the value of the US monetary gold relative to the broader money supply is also rising from near historical lows, similar to periods preceding the past bull markets that we had seen in, let's say, 1970s or even in 2000s. And finally, the declining status of the US dollar as a world reserve currency is also supporting the notion of a bullish outlook for gold. And if we compare, let's say, the US equity market size to the GDP over the past 120 years, it reveals the cycle of easing money, which is inflated due to equity bubbles, which is followed by currency debasement and rising gold prices. The pattern suggests that being overweight in gold as the equity market relative to GDP nears its peak is probably the right approach here. And what we are seeing, let's say, for instance, even when equity bubbles have been formed or they're bursting, central banks ease monetary policy, often overshooting what is the required measure. And ultimately, what that does is it helps propagate or set the stage for the next bubble. And this cycle, this sort of pattern that we've seen historically, is driven by the fiat or the traditional currency, which also leads to the currency value declining as gold prices rise. And ultimately, given that the current peak in the equity market relative to the GDP, gold prices could still see significant rise in the coming years. So what do you think? Do you think gold will continue to rise? Do you think gold, equity and cryptocurrency will rise together in the near, let's say, the next 6 months to 1 year? Do let us know in the comments below. If you liked today's video, drop a like, share, comment, subscribe. Do let us know what else you want us to cover. Thank you for watching this video. We hope you enjoyed it. See you next time.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.